Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets. And as Tori says, the news closely adjacent to the metals markets. And we do have a little bit of news this week. I think one big thing happened this week and some great chart stuff. So This is going to be a fun show. Last week was a pretty deep show. I know Dave and Kevin have been hammering in pretty hard on the bond auction and some of the implications there. So if you haven't caught the McElvany Weekly commentary the last couple weeks, I recommend listening to it and then going back and re-listening to it because it took me a couple shots to keep up with what Dave was talking about. So we're going to talk a little bit about that and look and see how that is affecting the metals market. So afternoon, gentlemen, who would like to open us up today?
I think Tori should open this up. He's all ready.
He does have the most papers in front of him of anybody at the table.
What are you talking about? This is all just in my head.
Right.
Yeah, that's the
25, 30. It's like just a ream of news.
One thing happened. Like, when was the last time we just had one exciting thing happen in a week? I don't think that's happened since Golden Rule Radio started so many years ago, but no, I mean, there's sentiment news, there's CPI news, there's Moody's downgrading. I mean, there's some big fundamentals, and I personally am shocked that gold is hanging in as strongly as it is. But, you know, we have a strategy that we employ and have for decades called the investment triangle. And as we diversify portfolios between growth assets like your equities, you know, stocks and bonds and mutual funds and what have you, and then your tangible commodities, which is kind of your insurance piece, and then the third piece, meaning your cash, and that can be T-bills and money market and things of that nature. Well, the U.S. dollar got absolutely crushed. So I kind of almost feel like we should look at the response of the dollar to the news, and then in turn, how the metals were impacted by that, and the equities markets really were impacted by that. And I don't know what you guys think. I mean, it really seems like that had far more to do with CPI than anything else.
Yeah, I mean, phony numbers coming out of the CPI. My insurance premiums fell by 36% last month. Come on, who are they kidding?
Last year. Yeah, they're saying year over year.
Yeah,
give me a break. So what do you do when the numbers aren't looking good? You change the way that the equations are performed, and that's exactly what happened. I mean, I saw somebody call the CPI CP lie. I thought that was really good. But
yeah, I like that.
Yeah, the Bureau of Labor Statistics, they're able to just literally say that healthcare declined 2% overall because healthcare premiums dropped 34%. And everybody knows that that's just not true. And they're going to have to answer to that. And likely, I think we'll see a revision coming up in the coming months. That's
very quietly.
Yeah.
Well, it's got to be like GDP and cost of living, right? Like they just remove the bad parts. They just removed the healthcare from the healthcare numbers.
There you go. Yeah, that's exactly what they did. And it's really frustrating because everybody just wants the truth. Like, we just want the transparency. Everybody's feeling it already. They can measure their budgets from a year ago to now, and everybody knows, the inflation, remember, even though CPI is now at 3.2% year over year growth rate, that's what it came down to. And I think it was 3.4 was expected. So it came in better than expected. Inflation had cooled a little bit more than they had expected. It's still there. Prices are still climbing, just at a slower pace, and it was lower than the expected rate of increase. And the equities markets just have gone crazy. I mean, the Dow Jones alone is up 3.5%, like over 1,200 points in a week.
Dow Jones transports are up 3.3% just today.
One day. But wait till you guys see the charts. It's gap.
Yeah.
This is, from my perspective, and I've been talking to a lot of clients about this. It's Thanksgiving next week. It's Christmas a couple weeks after that. People don't invest in December. It's not something we do. You know who does invest? Companies that are buying back shares, trying to push the price up so that they can game their end of year bonuses.
Mm-hmm.
Wow.
So you see all these market opens at the end of the year, big shocking surprise that the ups are gap over and over and over again. We'll look at that here in a second when we look at the charts.
Yeah, and you know what that gap means to the upside. It's going to gap down on the downside.
You always close your gaps.
Always
it may
close
take
them.
some time, but you do always close the gaps. And the Dow has a ways to go to get back up to the old highs. And the transports aren't even close. So even though they're both having phenomenal percentages, It's been so volatile that 3 or 5% doesn't mean anything anymore when you're talking about a 25 or 30% range in the S&P over the last couple of years.
Another Milesism, filling or closing those gaps. And, going back to that investment triangle, what you'll often see is that 2/3 of the triangle are doing well while 1/3 is faltering. And gold's not faltering.
No.
It's continuing to stay right there. The equities obviously have rallied, but the U.S. dollar is the weaker piece. Now, people are seeking yield. That's a big reason that the banking sector is so unstable. And there's now been over $120 billion tapped into from this emergency fund that the government established as a result of the SVB failure and what was going on earlier in the year. I mean, we're still in 2023, and now these banks are quietly drawing over $100 billion in short-term emergency funding. And nobody talks about that, but yet the banking system is just fine. But let's take a look at the dollar, if you don't mind, Miles,
Sure.
Starting this week with just the dollar. And again, this isn't a huge move, but we've been wondering, are we off to exceed the 110 again? Instead, we came below 105.
So zoomed out a little bit, the dollar actually doesn't look that bad, right? If you look over the last couple of years, it makes sense with the interest rate rises. But if we zoom in and we look at the dollar since October, we had a pretty strong bounce back up. The dollar ran so much last year, all the way up to 114,
Right.
115?
Over 115?
Yeah, you had to have a little bit of a pullback. We came back down to 100, perfectly acceptable. And we've broken back up out of that kind of downwards trading range we had through 2023. And it looked like we were starting to step up. And man, I really wanted to see like 108, 110. But the problem here is when you zoom that chart in and you just look since October, we topped out, bounced, topped out, but lower the second time, came even lower, came back up, but even lower this third time now. And now the dollar just fell off a cliff yesterday. Big down day for the dollar yesterday here at the beginning of November. So I'm not sold that the dollar's on the way down yet. Things have to be allowed to be volatile. Things have to be allowed to trade up and down. But short term, at least, I think you're seeing the dollar come down at least another couple points on the DXY as a minimum before we can even talk about going up higher.
So in that short term, that's good for gold. It's good for equities.
Sure.
In the long term, that's really bad for the government and the Treasury and the central bank in terms of their battle against inflation, right, Rob?
Yeah, I feel so bad for them, Corey. In the meantime, I'm trying to put food on the table and gas in the car and go to the doctor. Come on.
Yeah.
And you
Yeah.
drive a Prius.
My
But that's
wife drives a Prius.
Yeah.
But that's what's going to happen is it's
So
going
it's
to be
hard.
working against their efforts. If the dollar declines, that's another indication of a weaker dollar, weaker inflation is higher prices.
Oh, how about they rein in some spending?
That's right.
Yeah, good luck with that.
Well, no, and Congress just passed a patchwork sort of spending extension to keep the government funded until early in 2024. And so we'll see what happens after that. But there's no restraints right now.
None.
There's
And they're-
bigger
and they're-
military spending coming. But
Well, yeah, but the interest on the national debt's already more than the military spending, which is unheard of. And what's
over $1 trillion.
and what do you expect the budget deficit to be next year? Is it $2 trillion?
Yep.
Come on, seriously?
Yeah, it's not even close to being reined in. But that doesn't matter. All we have to do is play China and lie about our numbers. Pretty soon they'll deny the fact that our federal deficit is what it is. But again, look for numbers to be revised here in the coming months, and everything will get rosier. And keep in mind, too, next year's an election cycle. And the administration that's in control can oftentimes pull certain strings that make it more favorable for a re-election type of campaign.
We don't have a good track record for election years. 2020, 2008, 2000. I would think the government, the Federal Reserve, the powers that be, they're going to do whatever they can to keep things as calm as possible in an election year. And yet, when I look back at 3 or 4 out of the last 5 or 6 election years, it's not been pretty. Stock
No.
market crashes, COVID,
Moody's
Y2K
understands
things.
that. Yeah.
they
I
can
think that's
see.
hand in hand with the downgrade, right?
They can see what's going on.
And just be realistic. Now, I think they were smart in downgrading the future of the U.S. credit outlook on a Friday afternoon after the markets closed, and you had all weekend to absorb it. It didn't rock the markets, but this is like the third downgrade, and it's because of that political gamesmanship and lack of cooperation and the spending. So, yeah, the federal government's credit rating should be downgraded. Everybody else's is getting downgraded as credit card debt balloons and wages shrink and jobs are dwindling and people aren't working and life's getting more expensive, yeah, everybody's credit rating should be coming down.
So does it surprise you as we're seeing gold kind of in this band of trading over the last couple of years, the highs and the lows, and the timeline between the highs and the lows is starting to get shorter and shorter?
The timeline is shrinking, especially recently. You know, we've hit over 2,000 4 times in the last 5 years. The first time it had a correction back into the 1600s. Second time it rallied over 2,000 and it had a reversal back into the 1300s. And explain that one. How come the second time was a stronger reversal?
You know, the best argument I can come up with is more of a psychological one. I think there would be a number of people who maybe got into the gold market at the previous highs, like 2011, and they just sat there and waited 10 years just to break even. First time it hits it and we have a massive correction back down, they go, shoot, I missed it. So the second time it comes back up, they go, well, this is my chance. I think there's also people who might have bought through like 2014, 15, 16 at the bottom that are looking at it and saying, hey, I'm up 70% in 3 years. Yeah, let's scrape some profits off the top. So it doesn't surprise me to see a second reversal off of an all-time high actually being stronger than the first one, because you've got some reactionary people that quote unquote missed it.
But now the next time the reversal is shallower back into the 1600s.
Because those people are now out.
Right. And then it rallied again over 2000. And then here we are, the reversal off the fourth time. Now each peak over 2000, you know, the first one I think took 2 years to go from 2000 down back to 2000. The second one, it took about a year. Third one, half a year, 3/4 of a year. Here we are back again over 2000.
Yeah.
And so the timeline is shrinking. You know, the gaps between the tops are shorter, and the reversals now are much shallower. And here we are parked in the mid-1900s. Explain why we're hitting resistance, you know, in this 1970-ish price range.
Sure, great question. So on the long timeline we were just talking about, I would argue that, you know, like you're pointing out, first one is obvious, second one is a reaction, and then the repeating times we hit, it's kind of like dropping a ball, right? It's never going to bounce back up as high as you dropped it the first time. So you see that on the top end too. It requires less and less effort to try to push through the longer it sits at that price, because there's fewer and fewer people and institutions that are willing to take the other side of that trade and push it back down. So in the short term, we look at, say, what happened here over the last couple of days. So we had a great bounce. Lo and behold, you know, and I find this fascinating. Every time it happens, it's almost like the technical indicators knew that something was going to happen this week. And we have this massive bond sale that we've been talking about the last couple weeks. And lo and behold, your 382 fib, your 200-day moving average, and the Treasury bond sale all happen on the same day.
And gold hit the 200-day and the 382.
Correct.
Now, a week ago, we were thinking, well, it's probably going to drop to the 50 or the 618.
Yeah, and I'd love it if it still does.
Me too. Yeah, I still hope it does.
But, you know, it looked like we hit the 382, and I'm hoping that 382 point that coincides with the 200-day moving average is our floor.
Yeah. So
well,
now
it
you
could
ask,
be now because of that, the bond sale not going well and the dollar turning down, that will put the floor in the gold price in the short term.
Plus, they just came up with another $236 billion short-term Treasury auction, unscheduled.
Unbelievable.
Yeah.
I mean, a short term, in fact, that'll be today and tomorrow that's released.
Out of nowhere.
Out of nowhere. You can do $250 billion completely unannounced.
Yeah.
And that's desperate mode, right?
Yeah.
Right. So, and now you're asking about the shorter term. So, yeah, we've had this bounce, and we saw a little bit of resistance today despite the bond auction plus the out-of-nowhere bond auction. So we've come into what I call the neck of the head or the chin. You know, you kind of look at the trading range back when gold put the top in end of October around, 2010, I think we got to. So kind of the low point in that range is where we hit today and saw low resistance. Probably just going to be a blip. Gold's either going to continue the pattern it's been on, and we're going to see that 1911 or 1885, 1888. That'd be completely reasonable. But the fact that we had this bounce a few days ago, I just love when those things all line up. When numbers line up with events on the same day is always fun for me. It's almost like the market can predict something's going to happen.
All right, so what about transitioning over to silver? I've seen the ratio come down. We've had, 4.5 point swing in the ratio from high to low, today being the low. Silver's really hung in there above 23, but it's separated from gold here just in the last couple of trading days a little bit, up over 3% in one day, 2% another day.
So what are we, about 87 to 1 right now?
No, it's come all the way down to 83.
Is it really?
Yeah, that's the
silver's
4 point
had a
swing.
nice push.
Yeah.
Nice. Good for silver.
So the silver chart here, I actually don't know if I have a lot to say from the standpoint of like predictions going forward, because arguably I'm a trend guy and the trend is still down in silver until proven otherwise. We're just kind of at the top end of that declining trend or getting very close to it. We're at 23.5. We get to 23.75, maybe 24, and we're at the top end of that range. So we're real close to it.
Just like platinum. Platinum is
Right.
coming into the top end of its downward trading range.
Yeah, it's short-term range. We're going to
Very
see both
frustrating.
of them hit that top end close here. Maybe I just throw up my silver chart right now with everything on it, because silver right now is like a masterclass of learning how charts work, because it's just been so clean. We've had this long-term parallel correction down. We've been bouncing up and down above and below the 200-day moving average for months. Short-term, just since October, we've had this beautiful 382 trading range. We had a dip down, almost perfect 618 bounce. We moved back up. Here today, yesterday and today, we've broken above the 200-day moving average. So I wouldn't be surprised to see a retest. Like, from a guy who likes charts, we had RSI divergence. This is a fun chart for me just to look at and say, sit down with one of the new guys here at the office and say, hey, you want to learn some charting? Let's walk through the last 6 months of silver, because it's textbook. So from a prediction standpoint, I mean, I'm a trend guy. Silver's down until it says otherwise. And saying otherwise is $25, $26, $27 silver. And then you can start saying, okay, we're in breakout territory. Silver's going to 32, 35, 45. We're not there yet. So for me, ratio is starting to inch back down. Anything over 80, just if you're buying some gold, put a third of it into silver.
Yeah.
It's just a no-brainer at $22, $23.
And a ratio in the mid-80s.
Exactly.
Yep, that's the game.
Well, and I really like the platinum chart, even though I don't like what it's showing me. I think the platinum chart is very illuminating.
Yeah, platinum is actually still well below its 200-day moving average. So platinum, yeah, we had a bounce on that declining, looked like the floor, the short-term declining trend line since about April. Platinum's just been stair-stepping down. We had a bounce. Need to see platinum maybe in the 970-ish range for me to argue it could be turning back around and going up to the longer-term trading range, which would really put it up at like 1,080, 1,100. So platinum has a long way to go too.
Yeah.
I'll tell you the most exciting thing about it, though, is it's just inching closer and closer to palladium.
Right.
Or you could say palladium is
forget
screaming
the dollar
towards
price.
Right.
Yeah, no,
Look-
forget
look
the
at
dollar
that.
price.
It's
Talk
within like
about
$130, $140. I mean, it was,
It's
palladium.
15%. Yeah.
Yeah, palladium was almost 3 times the price of platinum at the peak.
It is the most beautiful looking ratio trade we've seen in decades.
Yes.
Right.
Yeah.
It took a while.
It was
It took a
literally
long time. It took
60%.
decades.
Yeah.
Not quite.
Not quite. But yeah, it
felt
was
like it.
60% below the price of palladium. Now it's only 15%. And that doesn't sound like much, but that is a huge
Big
ratio
deal.
swing. And there are huge wins in the ratio trade just when they get to parity.
Yep.
That's a doubling of ounces right there,
Right there.
if somebody got it just at half the price of palladium. So,
Yeah.
yeah, we're excited about that trade. And from there, it just keeps on screaming. It'll go, 1.5 to 2.5 times the price of platinum at some point, or palladium, I mean.
Right.
And
I know
it'll
you
really
meant,
be
yeah.
probably palladium continuing its correction back down. It just got so overvalued and speculative.
Well, rhodium too. Rhodium was
Yeah.
35,000. Now it's hovering around 10,000.
Yep. And it needs to come back down to about 2,500.
Yeah.
Yep.
Yeah.
Not bad, guys. I'm going to close the charts out with one we already talked about, the Dow. So I'll slap the Dow chart up here. Dow's in a rising channel. I was hoping, because I'm a pessimist, to see the Dow break down to like 32,000 on the recent dive. It didn't. Bounced a parallel channel just about perfectly. Came back up, danced around its short-term 618 fib for a day or two, but it's just gap up, gap up, gap up. I think I count 4 gaps here from 33 to 35,000. So big move up in the Dow. I wouldn't be surprised to see if we kind of trickle up a little bit further. Keep charging. You know, the fullback that has 3 linemen hanging off the back of him, he starts to slow down a little bit before he goes down. I think that's what the Dow's probably going to do. And then I think we're looking at coming all the way back down to the 200-day moving average, which is down where we started, around 33,000. So who cares what the Dow does if it's below 37 or above 30?
Well, and it's just going to happen, Miles. That correction's going to happen, right? Anytime you overshoot, we talked about this in gold and silver. I mean, we see it, that separation from the moving averages. It's going to happen. There's going to be a lot of people upset because this speculative little run has occurred because the inflation numbers came in better than expected. Why does that matter? Because they think that the Federal Reserve won't hike rates again.
Correct.
And
Right.
if they don't hike rates, then the economy doesn't stall to the level that it is. So it's time to buy. And they're getting ready to find out it's not yet time to buy. And the growth portion of the triangle is going to get smacked again.
It's a whole lot of screaming and nobody's saying anything. That's the charts for the last couple years. Gold, $400 trading range. Dow, $8,000 trading range. Like, who cares at this point? Something's going to break the levees. Something's going to break the levees eventually. Right now, it's just people arguing over nothing and massive volatile price swings up and down. And you look at your stock portfolio over the last 3 years and you realize at best you're treading water for the last 3 years and probably down 5 or 10%.
It is a tug of war,
Yeah.
is the way I look at it. You know, there are some big pulls and teams are getting close, but nobody's getting pulled across the line. And there's going to be some teams getting pulled across the lines.
Yeah.
And that's when we're going to really have clarity of direction for a while.
And like we were talking about earlier, see how this all ties together? We were talking about earlier how the time frame between those peaks and troughs, the frequency at which those things are getting is getting
compressed.
short. Yeah, more compressed over time.
Mm-hmm.
Like eventually, yeah, it's going to snap. And it's going to snap probably relatively soon here.
Mm-hmm.
And then Powell has a real big decision to make. How much can I get away with on the bond auctions and the buybacks? And Rob, I know we talked about this last week. I cannot wait to see what the central bank balance sheet looks like for their monthly report when we get that.
Bingo.
So can't wait to see how many of those 30-year bonds they bought back up because the market didn't buy them.
No.
We'll take the 1s and the 2s, like Dave said on the show this week. We kind of want the 10s and we ain't touching the 30s.
No way.
So that's going to do it this week for Golden Rule Radio. As always, we appreciate you stopping by. In observance of Thanksgiving next week, we will not be recording. We will be taking the week off and picking up the following week. So hope you and yours have a wonderful holiday weekend coming up next week. If you'd like to speak with one of the advisors here at McIlvaney Precious Metals, you're always welcome to give us a buzz. We can be reached at 800-525-9556. You can find us on our website at McIlvaney.com. We're on Twitter at ICA Gold or Facebook at McIlvaney Financial. Thanks for listening and have a great week.